Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracy Reinick, and this week I'm joined by Zach's Director of ETF Research, Nina Mishra, to talk about what are the hottest ETFs here in 2020. I had some guesses kind of going into this podcast what might be hot because we all kind of know, right? But what is really going on out there? I was kind of surprised at the list of what was hot in the first half of the year. And I know some of the things that are bubbling up and maybe going to be on the second half of the year list here, Nina. But I guess nobody should really be surprised that with tech kind of leading the way here, the QQQs are still like super popular. They were popular when they launched that ETF like way back in the day during the dot-com boom. We all owned it. And I feel like it's making a comeback here. It's the one to own for 2020.
Right. Hi, Tracy. Thanks for having me on. So the first half has been very interesting, and that's an understatement. Yes, we saw some very interesting trends in the ETF world. And talking about fund flows, bond ETFs got a lot of inflows, which was pretty interesting. And that trend we have seen last year to bond ETFs attracted a lot of money. And this year, bond ETFs got a lot of money from institutional investors like insurance companies. And then there were some investors who were trying to front run the Fed when they announced that they would be buying corporate bond ETFs. So we saw a lot of inflows into corporate bond ETFs before the Fed. But in general, bond ETFs have been pretty attractive to investors this year so far. Then commodity ETFs got a lot of new money, and that is because gold has been so hot. Gold is up about 27% this year, and of late, silver has been doing so well. So gold ETFs attracted a lot of inflows in the past 3-4 weeks. Silver ETFs have also gotten a lot of new money. And then a lot of investors, particularly Robinhood investors, they have been pouring a lot of money into oil ETFs. They have been betting on oil rebound, and particularly leveraged oil ETFs like GUSH, UCO, and RGU. They are pretty popular on the Robinhood platform. But as you mentioned, QQQ has been hot this year. It is number 5 on the leaderboard in terms of asset gathering. And that trend we have seen in the past few years because technology is the best performing sector this year. Technology was the best performing sector last year. It has been the best performing sector over the past 10 years. And QQQ, the NASDAQ index, has significantly outperformed the S&P 500 and the Dow over the past 10 years and this year as well because of its exposure to big tech. Now, another reason why QQQ is very popular with investors because this provides exposure to all those hot FANGs, Microsoft, all those hot stocks, whereas the technology sectors ETFs, the most popular technology sector ETFs like XLK and VGT, they do not own Amazon because Amazon is in the consumer discretionary sector. They do not own Netflix. They do not own Facebook. They do not own Google because Facebook, Google, Netflix, they went to the communication services sector 2 years back because there was a reorganization. So that is why QQQ is now the best ETF, in my view, to own all big tech. So that is why it has been very popular with investors. So those are some of the interesting trends we saw. But, as you mentioned, things may change in the later half of the year. We will see.
Yeah, I was surprised to see, but I shouldn't be because I knew everybody was trading in it, that U.S. oil fund, USO, was at number 9 for the first half of the year. But it seems to me like that trade is kind of over, because I did take a look at the GUSH too that you mentioned earlier. Now, I wrote in my notes here, scary, next to the GUSH ticker, because that's the S&P Oil and Gas E&P bull 2 times. So this owns the E&Ps, and they've really rebounded off of those March lows, but they haven't done anything in the last couple months. So I'm wondering if people are just like, they played that trade and now they've abandoned out of there. I saw in June that GUSH was up. It spiked 107% in June when all those E&Ps were spiking up there. But like I said, they've kind of just, they've died now. They're not going down, but they've just kind of flatlined. So I would think that the Robinhood traders might be out of that one. But the U.S. oil fund, USO, was the popular way, or I guess still is, to play the change in the oil, the crude prices.
Yes, it is surprising that oil ETFs and leverage oil ETFs also, they still remain popular on the Robinhood platform, but they have come down on the leaderboard a little bit, because this rebound seems to be over. Right. Another ETF which was very popular with Robinhood traders was JETS, which is the airline ETF, and that's the only airline ETF, whereas in case of oil, you have a number of choices available. You can bet on unleveraged E&P. You can bet on ETFs that track the commodity using futures, and you have a choice of leveraged ETFs too. So many choices available. In case of airline, when the economies started reopening, a lot of people were betting on the airlines rebound. So JETS was really popular. It got like $1 billion in inflows within a few weeks. Wow. But I have seen that because, most states have, pared back their reopening plans. Some of them have started reclosing some parts of the economies, like the bars and, in indoor dining. So, and airline travel, which had picked up a little bit, has come down again. So JETS is not so popular with Robinhood traders now. And in fact, when JETS was really popular, people started talking, Warren Buffett sold airlines at the wrong time, and we are better than him in terms of investing. And probably he was right in the longer term. You never know.
Right. He'll likely have the last laugh, I have a feeling.
Right.
Okay, so I know in a lot of the podcasts that we have done about like the ETF world and the hot ones, we have covered the cannabis ETFs in the past. And how is that doing this year? Because I know a lot of the cannabis stocks have fallen down, but maybe not so much like, the full-fledged ETF. And I know we've talked about the alternative harvest ETF, the MJ, as being one of the cannabis ETFs. And I see year to date it's down 19.5, but are people still diving into that one, or where does cannabis fit in this year?
So surprisingly, cannabis ETF also remains popular on Robinhood platform, and it is one of those you can see on the leaderboard. And cannabis kind of rebounded from its March lows for some time, but then it has remained flattish since June or something. And MJ is the only cannabis ETF which has probably managed to gather some assets and managed to remain popular. And there are many other cannabis ETFs which are available to investors, and most of them they launched last year, and because cannabis was down so much last year, so that is why they launched, and they failed to gather assets, and they are kind of still struggling to gather assets and gain any investor favor. It's just because MJ was the first one, so it got first movers advantage, and it just remains popular and well known. So that is why traders who are still betting on cannabis, they like MJ, but not other cannabis ETFs.
Okay. And just for anybody out there who is considering getting into MJ, the biggest holding is GW Pharmaceuticals, which has a cannabis-based drug for epilepsy in children. That's the biggest holding at 10.7%. So you're not necessarily going to only own the growers or things like that in that ETF. Okay, so let's move on to some of the kind of interesting ones that are launching here in 2020, because there's never a dull moment on the ETF side. They always come up with like the most clever kind of, timely, trendy ETFs that you can be buying out there. And I know you gave me a couple names before we went into this podcast, so I did think they were interesting. So let's start with this one that's on sports betting and iGaming, this Roundhill ETF, BETZ, good ticker again, is the ticker. But this one just launched, right?
Yes, this has been one of the very successful launches of this year. So it just launched and it already has about 88 million in assets. It launched in June, so less than 2 months old and already 88 million in assets. That's pretty good. And that is because this is the first and only sports betting ETF available to investors. And, when physical sports are slowly returning without fans, of course. So probably we will have more betting on sports. So that is why investors have been putting money into the ETF. And this is also very popular with younger newbie investors on Robinhood platform. Now this company, Roundhill, also has a video gaming ETF, and that despite very good performance, did not manage to gather a lot of assets. That is because video gaming already had 3 ETFs in this space. So the video gaming ETF, which also has a very good ticker symbol, NERD, that is one of the cheapest video gaming ETFs, and that managed to gather just about 31 million in assets, though that has been around more than a year compared to BETZ. So it's just first movers advantage, and sometimes something that just clicks with investors, people who have been at home and they want a way to invest bet on sports. So they probably liked BETZ, and its launch was pretty successful.
Now I see some of its holdings. I took a look there just to, figure out like what are they putting in this, and they have DraftKings in there, Churchill Downs, but it looked like some of the names were ones I wasn't familiar with. Are these like foreign companies, like foreign betting companies, or do you know like what's
Yeah, it has a lot of international exposure too. And the video gaming ETF and sports betting ETF, both they have a lot of international exposure because these are international trends. There's a lot happening in other parts of the world. So that is why you see a lot of international holdings that we do not recognize at all.
Cool. So let's move on and talk about some of the coronavirus ETFs, because of course there have to be some, and I know you've covered some of these on your own podcast with the companies that are starting up some of these interesting ones. So the first one you sent me was GERM, GERM, which is the Treatments, Testing, and Advancements ETF. And this one, I took a look at what they owned. Novavax is their number one holding. They have Moderna in there, LabCorp, like the testing guys, obviously, because it says testing in there. So is GERM the one you want to own for the vaccine?
Yes, GERM also has been very popular with the new investors in particular, and also it appears on Robinhood leaderboard too, very popular with the Robinhood traders. And it's an interesting ETF, definitely, because it invests in companies that are either developing tests or vaccines or therapeutics for the coronavirus and other infectious diseases too. And this also launched a little over a month back, and it has managed to gather almost 70 million in assets. Pretty impressive in terms of asset gathering, and pretty impressive performance too, because as you mentioned, Moderna and Novavax are its top holdings, and those two shares have surged in the past few weeks because of some vaccine news. Moderna, in particular, they announced that their experimental vaccine, the COVID-19 vaccine candidate, is now entering the late stage trial, and it may be available later this year. So Moderna shares have surged a lot. So this ETF is a good way to invest in. If you want to invest in vaccine stocks, probably a better way is to use an ETF, because those all the companies that are developing these vaccines or treatments for the coronavirus, we know that very few of them are ultimately going to be successful.
Right.
Many of them will not make it to the market. Many may make it to the market, but many have also announced that they do not intend to profit from any vaccine or treatment for this coronavirus. And so this is a very rapidly evolving area. So I think an ETF approach is better. But personally, I think a better way to invest in all these developments is using a broader biotech ETF
Okay.
like XBI, which is equal weighted and has a lot of exposure to smaller mid cap size biotech companies, or IBB, which is market cap weighted. So whatever you want, whatever you prefer, because in general, we will see a lot of spending on vaccines, therapeutics, and healthcare in general in the coming months and years by governments, by investors. So why not just take advantage of all that and invest in a broader biotech ETF rather than just betting on an ETF that invests in just coronavirus vaccines? Because what if we get a vaccine later this year? I do not know how these stocks are going to perform next year. There's a lot of uncertainty. So if you want to bet on virus stocks, probably this is a better way, but otherwise take a look at biotech ETFs in general.
Okay. And another one that is just launched that is kind of trying to cash in on what's happening around the world right now is the work from home ETF, WFH, of course. And I took a look at what was in this one because we can all kind of guess, right? Like Zoom video is going to be in there, Microsoft, like some of those. They did say that they look at global companies, so any kind of company that would be globally. But this seems like it's pretty wide kind of categories, like almost anything could kind of be in there other than like restaurants or hotels.
Mm-hmm. So this ETF this has been a successful launch. It launched June 25th, and this also has almost 66 million in assets, and that is a very successful launch, I would say. Pretty reasonably priced at 45 basis points for a thematic ETF. And if you look at the strategy, so it invests in four technology pillars. And those four pillars are cloud computing, cybersecurity, online project and document management, and remote communications. So in addition to all the very obvious companies like Zoom Video, Okta, Twilio, you will also, and CrowdStrike, you will also see some companies that we are not very familiar with. And you will also get exposure to the big tech companies like Amazon in the portfolio, but this is an equally weighted ETF. So Amazon is not going to dominate the portfolio. Amazon is at 2.7% in the portfolio. But I think work from home is a trend, which is going to stay here for quite some time. Twitter and Square, they have already told their employees that they can work from home forever. Just yesterday, Google announced that the employees have a choice for working from home till July end next year. Facebook has said that many of its employees will be working from home forever. So this is a trend which is going to continue even after this crisis is over. So I think it's an interesting way to invest in those companies. But one thing which I would like to add that many of these companies probably investors already own in either their technologies or their software ETF or their cloud computing ETF, because cloud computing ETFs have been really popular this year. Even before the ETF launched, there were other cloud computing ETFs, pure play cloud computing ETFs that have done really well this year, and they have attracted a lot of inflows.
Okay. An area that I was kind of snooping around in that wasn't on any of the lists that you sent me for this podcast. So I'm kind of curious, like, is it kind of like a hidden opportunity area, or I don't know, nobody's caring about it right now, but that's the home builder ETFs. And those, like the last time the home builders were like super hot was in 2012 when they were the best performing sector on the S&P 500. So that's a lot of years ago now. That's 8 years ago was the last time they were good. But there are a couple of those home builder ETFs that are out there. There's the XHB, the Spider S&P home builders, and then there's that ITB, which is like the home construction one. But what's going on with the home builder ETFs? Or does no one care right now, even though the home builders are super hot? Or is it, I don't know, because we haven't mentioned it on this episode until right now.
Yeah, so that is a bit surprising that they don't get a lot of headlines despite their impressive performance. But looking at the assets, they have been able to gather good assets. In fact, year to date, ITB has gathered up more than 800 million in assets, and XHB has managed to gather about a little more than 200 million in assets. So yes, they are slowly gathering assets because housing continues to heat up with record low interest rates, and I hear the inventory is also very low in the housing market. So that is another reason why housing is doing so well. Home builders are so hot. So I expect them to pick up pace in terms of asset gathering later this year if housing continues to be hot.
Okay. Just an FYI to anyone who's kind of interested in the housing side, both of those ETFs do own all the like retail housing retailers like Home Depot, Lowe's. I see Sherwin-Williams is in the ITB, and like Masco is they make kitchen cabinets and plumb like faucets. They're in a couple of them too. So you're not only going to own the home builders in these, you're going to have like the whole home industry, but the whole home industry is super hot. So in today's climate, you want to own all of those if you're interested in like the home as a play on what's going on out there. Okay, we're going to wrap it up with one other area that we did mention at the top of the episode because it is among the hottest of the ETFs for the first half of the year, and I think it's really going to pick up in the second half based on what's going on. But you mentioned it already. You mentioned the gold and then the silver. So I saw that the number 3 in inflows was the Spider Gold Trust, the GLD. And I'm having a little bit of flashbacks to like during the housing bubble, because that's when a lot of these ETFs launched for the gold and the silver. The SLV is the silver one, and those hold the physical gold. And I bought those because I thought the housing bubble was going to blow up the U.S. economy, which it did, and that gold and silver would soar. And they did, but then it kind of petered out in the middle of the last decade and didn't do anything. So I got out of all my positions in all of these. And I even owned a couple of the other ones that we should also talk about that I think are going to start to be very popular again as well. And those are the gold miner ETFs. There's those VanEck Vectors gold miners, that's the GDX. And then there's the junior gold miners, GDXJ. Again, I'm having flashbacks because I owned both of those at one point, and now they seem to be back in favor again as obviously gold and silver are surging here. So what's going on with the whole gold silver ETF scene right now? Is it really, I mean, it looks like it's like that hot. Is it really that hot?
Yeah, gold ETFs have gathered a lot of assets this year. And again, investors tend to chase performance. So because gold has done so well, so that is why they have been pouring a lot of money into gold ETFs. And in general, there was a note from Goldman this morning, I think. So everyone is talking about this unprecedented monetary and fiscal stimulus all over the world, which has brought down the interest rates to such low level. So there is basically no opportunity cost for owning precious metals now, gold or silver, because they do not yield anything. And there is a belief, because there is so much money in the system, and raising interest rates would be very difficult for central banks anytime soon. So inflation is going to pick up sometime down the road, maybe next few months or after a year or so. And it would be, as I mentioned, it would be difficult for central banks to raise interest rates to tame inflation. So in that scenario, people have been buying gold, and silver is another, a little bit different. In addition to being a safe haven, it has so many industrial uses. It is used in solar panels, in the photovoltaic cells. And so it gets a lot of demand from China, because China is the biggest solar market in the world. So with Chinese factories reopening, silver has really picked up over the last month or so, surged over 36% over the past month. So silver ETFs have attracted a lot of inflows, and we have seen that dollar has weakened substantially in the past couple of weeks or so. So that also benefits gold and silver, and we will see whether that trend continues. But I just wanted to add that if you want to own gold, then there are cheaper ETFs available with much less expense ratio than GLD. Okay. GLD is it is the most popular gold ETF, but it charges 40 basis points. So if you are a trader and if you want to just trade in and out of gold, then GLD is your ETF because of its excellent liquidity. But if you want to own gold in your portfolio over longer term, because of the reasons that we discussed, and if you think gold deserves a place in your portfolio because of its diversification benefits, then there are a couple of gold ETFs, which, in fact, 2-3 gold ETFs, which are much cheaper. There is a mini version of GLD, which was launched by State Street. It is the ticker symbol is GLDM, which charges just 18 basis points, and that also has more than 3 billion in assets, pretty liquid, not as liquid as GLD though. That is very good for long-term investors. And there is SGOL, which charges 17 basis points, and there is BAR, which also charges about 18 basis points. So those are good tickers for investors who want to own gold for the longer term. For silver, there is not a lot of choice available, because obviously silver is not as popular. It had underperformed gold over the last many years. SLV charges 50 basis points. There is a cheaper ETF available which has less liquidity than SLV. The ticker symbol is SIVR, SIVR. It charges 30 basis points. So again, if you want to invest in silver for longer term, then SIVR is your ETF. But silver, investors should remember, is much more volatile than gold. It is not exactly a safe haven asset, though it has partial safe haven qualities too.
What was the first one of the cheaper, the gold ones, GLD? What was the final letter? Was that M?
Yes, GLDM, mini version of GLD.
Okay, I see. I'm like, why did they choose M? I see.
So it is called mini for two reasons. GLD tracks 1/10 an ounce of gold, and this tracks 1/100th an ounce of gold. So if you want to invest smaller amounts at a time, then you can look at GLDM. And then in terms of expense ratio too, GLD is 40 basis points and GLDM is 18 basis points.
Okay. And then the gold miners, I do want to warn people that you are buying businesses there. You're actually buying the gold miner businesses. So all the things that apply to businesses apply for those ETFs in terms of, labor issues, weather issues, geopolitics issues. There's all these things that go on with the actual miners. They have to get it out of the ground. And so that's a little different than owning the physical metal, which is what these other ones you were just talking about, Nina. But a lot of people do like the gold miners because when the price of the underlying commodity, just like the exploration and production companies on the oil side, they will see higher earnings off of those prices. So again, the GDX is the bigger gold miners, and the biggest position in that one right now is Newmont at 13.6%, and then Barrick is at 13.2%. The junior one tends to be much more volatile because the companies are smaller in there, and it owns a lot of silver miners. And so just be aware, right now, nobody cares. That's probably a good thing right now, but there just simply aren't enough junior miner companies to put in there, so they had to put silver in. And I noticed that Pan American Silver, for instance, is the fourth largest holding with a 5% position in that miner. So that kind of tells you that they have to put some of these silver guys in there too. So, but you're getting both in that one right now. And again, I'm having these weird flashbacks because I remember owning all of these, and I think I owned Pan American Silver itself as a company at one point. So I don't know what this means, Nina. Like, I don't know, what goes around comes around, and it could be time again for some of, the commodities again, especially gold and silver here in 2020.
Yes, as you mentioned, these are leverage plays on gold. So investors should always remember that they are much more volatile than gold and silver, and particularly the junior one is going to be even more volatile than GDX. But when gold goes up, they do very well. When gold goes down, they do much worse than gold. So if you invest in them, look at your risk appetite and treat them as shorter term holdings in the portfolio. These are not buy and forget investments for sure.
Right, for sure. Okay, well, we've covered all the hot areas today. That was a lot. A lot is going on, and ETFs are a great way to play a lot of these kind of trends. Because you do get like a basket of the companies in the certain area. You don't have to go out there and figure out like, hey, which gold miner should I be buying right now? Although a lot of people like to do that, and that's fine too. But this way you just get exposure to some of these hot areas without quite, having to figure out like who is who in each industry.
Right. And one thing I would like to add, that apart from all these hot areas, which are very popular with shorter term traders, but when I looked at even at the Robinhood leaderboard, I found that some of the very stable, very large ETFs, broad ETFs, like VOO, which is the cheapest S&P 500 ETF, charges us 3 basis points. That is pretty popular on Robinhood. So a lot of day traders, newbie investors, they are investing in VOO. Another one is VTI, which is the total Vanguard total market ETF, which also charges just 3 basis points and basically provides exposure to the entire stock market in the US, including large cap, mid cap, small cap, and micro cap companies. That is pretty popular on the Robinhood platform and QQQ too. So all these broad ETFs that are very good for investing for the longer term and which deserve a place in the core portfolios. They have also gathered a lot of assets this year from institutional investors, from ETF models, and also from newbie investors on platforms like Robinhood. So that is a really good and encouraging trend that newbie investors are not just investing in oil and marijuana and airlines, but they are investing in these broad market ETFs too.
Yeah, no, that is a good trend. So glad to hear it. Okay, well, we'll see what happens in the second half of this year and if some of these hot areas remain hot or cool off a bit and other ones surge up there. Now, I'm about to give the list of all the ETFs we discussed today. It's quite extensive, so I'm just going to kind of, I guess, go down my notes here and see if I can hit them all. Okay, so we did discuss the gold trust, the GLD. We did the QQQs. We did the U.S. Oil Fund, USO. Then we mentioned briefly just the technology ETF, the XLK, but we didn't really talk about it, but I'll list it here anyways. We did JETS, the U.S. Global JETS ETF, JETS, the Alternative Harvest ETF, MJ, that's the cannabis one. We did the Roundhill Sports Betting and iGaming ETF, BETZ. We did the video gaming, we mentioned that one, NERD, NERD. We mentioned the S&P Oil and Gas E&P Bull 2 times, which is GUSH, good ticker GUSH. Then we talked about the Treatments, Testing, and Advancements ETF, GERM, GERM, as in Mary. And we also mentioned you could do the biotech ETF XBI or the IBB if you want something a little broader there. Then we mentioned work from home ETF that just launched. WFH is the ticker. Okay, moving on. We did the home builders. We mentioned those, XHB and ITB. And then finally, we moved on to the rest of the commodities, the gold and silver, the iShares Silver ETF, SLV, and if you want the cheaper version, SIVR. And then we already mentioned the gold ETF, GLD, but the cheaper version, GLDM. And then the gold miners, GDX is the big gold miners, and GDXJ is the junior gold miners. And then Nina just mentioned the overall market index, the cheaper ones, the S&P 500, the Vanguard one is VOO, and then the total market Vanguard is VTI. Okay, I think we got them all in there.
Wow, we discussed so many.
That's a lot, but a lot of good ideas, so people can go, look them up on the Robinhood app and see what floats their boat. But a lot of things are hot right now. And again, the ETFs are a great way to play it. So we're going to cover some more in the second half of the year. You want to be sure to subscribe to the podcast to get all the podcasts here. You can get us on Apple Podcasts, and we're on Spotify. And of course on SoundCloud, where most of you are getting us. But be sure to get it somewhere. And I'll see you again next week with some more stocks or ETFs.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.